I'm Sabina, CPA. I advocate less taxes and more profits. Today, I'd like to go back to the basic and talk about stock compensation and taxation 101. Since we're located in San Francisco Bay Area, quite a few questions have come up from clients working in the technology sector in the Silicon Valley. Compensation comes in the form of cash, such as wages or salary, or it can come in the form of stock options, a stock compensation, and employee benefits such as free lunches, medical insurances, or other fringe benefit. They are all tools to attract, retain, and incentivize great talent. In this session, I want to specifically demystify stock compensation. And what are the type of stock compensation? They fall into two broad categories. The first one is restricted share units, RSU for short. The company grants stock to you outright with certain limits. RSU, the incentive is for you to stay and contribute to the company's growth, company's stock price growth, and therefore increase your financial gain in holding the company's stock. RSU have a vesting plan in which certain milestones must be reached before the stock can be sold and cash distributed. The second bucket or second big category is called stock options. The company gives you the options to purchase company stock at a predetermined price at a given time. Usually that predetermined price is lower than the current trading price of the stock, so that a gain is already built in and act as the incentive for the employee. However, if you leave the employer before vesting, you would lose this benefit. And currently, there are two types of stock options in use, with one more common than the other. The first is called non-qualified stock options. You will see initial SNSO. This can be used to incentivize numerous people that support an organization, including outside consultants and board directors. So NSO are more of a perk offered to all employees and receive no special tax treatment. The second type of stock option is called incentive stock option, abbreviated ISO. This generally is given to incentivize team members to greater job performance. They're most often used with C-suite executive or key team leaders. ISO tend to receive preferential tax treatment, as the thinking behind ISO is that such incentives strengthen business performances and by extension the overall economy. Now, how do they work and how do they impact my taxes? For RSU, for the restricted share units, RSU has no value unless or until the vesting terms has been satisfied. For example, certain company or individual performance goal are achieved, or months or years of service are reached. At the point of vesting, you are given share of the company stock and you can sell the share if you choose to do so. You'll be taxed on the market value of this share at this time, and the tax will be withheld from the amount your employer pays you. You can ask your employer to defer settling the share for a short time after vesting, therefore delaying paying income tax on it a little bit longer. But your employer has to make sure all tax laws are carefully followed. Even with RSU, there are a couple of things to be aware of. One is called the single trigger RSU. A single trigger RSU tax you as it vests. That means with each vesting date, you would have tax taken out based on the market value at the time of vesting. This will be taxed as ordinary income unless you hold a stock for a year or longer after vesting, at which point it becomes capital gain. There is the double trigger RSU. This only applies if you join a company and take the RSU before it has gone public, i.e. Initial public offering, IPO. In this case, generally the tax will be due at the date the IPO is made and that your RSU has vested at that point. When an IPO is taking place, your employer would likely give you a deadline at which time you would need to exercise your options. You don't have to wait until the last day of that deadline, but you may want to. This will give you extra time to research what the tax repercussion will be and make the best decision for your own bank account. The tax implication for stock options. Once the predetermined period ends, this stock option can become common stocks if you choose to exercise them. With stock options, you have more flexibility when it comes to taxation. You'll pay tax if you choose to exercise and sell the share. If your stock option is of the non-qualified variety, the NSO, when you sell the share, you'll pay income tax on it. For ISO, which is reserved more for the C-suite and key employee, the tax you are charged will be paid at the going capital gain rate at the time of selling the share. If the stock share price drops to the point where they are below the option price, your options will lose their value. That means your investment won't have any worth. Obviously, there will be no tax consequences. The last question related to stock compensation is, what other implications are out there beyond the taxation? And for the benefit of your overall financial health, please remember a few things related to your stock compensation. One is reinvestment. When you reinvest any proceeds you have made from your stock compensation, it doesn't mean you have to abandon your employer altogether. If you will work there still, you may want to put some money back into share in the business you are helping to build. The key is to keep your portfolio diverse even as you are holding shares in your workplace. The second thing to look for and be careful is diversification. Although stock compensation is a great job perk, they shouldn't be your only financial plan. It's dangerous to rely only on share in any one company, whether when you are preparing for your future, even if you believe in your employer and the work they're doing. If something happened along the way, you could stand to lose your entire investment. So the best way forward is to build a diverse portfolio of companies that are in completely different industry. If you work for a tech firm, for example, investing only in other tech firms won't serve as a protection if the entire industry takes a nosedive. It may also help to seek out the assistance of a financial advisor if you're interested in building a portfolio. Whether you should take a chance on some riskier investment while also putting money into low-risk options depends on your age and your current financial standing. Please feel free to reach out to us to see how we can be of assistance to you in this regard. And if you find this video useful, please click on like, subscribe, and forward to those who may also benefit from this tutorial. Please also head to basecpaplus.com to sign up for our email newsletter full of tips for less taxes and more profits. Until next time, God bless.